build up the product cost. As we saw last week, the cost of goods manufactured is the product cost. And when we look on the other side to the headquarters, the non-manufacturing costs, all of these, they are period costs. They are not associated with the product costs. They are period. They are costs of the period. They are not related with the product directly. So when the product costs, before they are sold, they stay in inventory and they are recorded as an asset in the inventory balance sheet. Only when they are sold, they will be considered as an expense during the period. Okay, and it goes to the P&L as cost of goods sold. So if you remember the diagram that we had last week, that little one in the middle, we can see that when we have in the middle the cost of goods manufactured, these are product costs, and they stay in inventory as an asset in the warehouse. Only when we sell the products to clients, cost of goods sold, these will be going as an expense in the P&L. Okay, is it clear? Any questions? No? Okay. So it's very important for organizations to distinguish between functions. So we have seen the different functions of the organization. We have the manufacturing, we have the non-manufacturing areas. And for us, it's important, and for us and companies, it's important to have this to distinguish between these functions. Because if we look at manufacturing organizations, so any products that we have, any big brands of products that we have, they produce these products, and that is the main activity. So it's very important that they are profitable in the main activity, which is to sell the products to the clients. And it's important for organizations to understand how much costs they incur with the production of the costs. Okay, and that is why companies, they develop the profit and loss account by function, so the P&L by function. So is the profit at the end, it should be the same as the profit that we have in normal income statement, in the normal P&L. But the way that we work out the costs in the P&L will help managers to make better decisions, to understand what's going on, what is the cost structure of the company, in order to make decisions in terms of investments, costs, etc. So what is the structure of the P&L by function? It starts with sales revenues, and then it deducts the cost of goods sold. So then there we have already the gross profit, the difference between sales revenues and cost of goods sold. So this is really important for managers to understand how profitable the products are. And then when they have different products, or when they have different stores, and they can compare. So which product is more profitable? Which store, which location is more profitable? So they can have this comparison and make decisions based on this. And then they will deduct the non-manufacturing costs, like selling costs and administrative costs, which will give the operating profit. And finally, they will consider the financial costs and revenues to have the profit before taxes. So this is the P&L by function, which compares to the P&L that we normally have in financial accounting, in which we have sales revenues, changes in inventories, the total operating revenues, then the cost of merchandise sold and materials. Then we have miscellaneous, we have personal costs, depreciation, etc. So when we look at all of these items that we have in the P&L in financial accounting, so for instance, if we look personal costs, we might have personal costs that are, some of them are manufacturing, others are selling, others are administrative. When we look, for instance, at the cost of merchandise sold and materials used, part of that materials used, you see, is part of how we calculate the manufacturing cost, the cost of goods manufactured. Miscellaneous costs part of it will also be manufacturing, and another part will be non-manufacturing. So it's just a way of assembling costs differently and then work out this information in order to help managers to make decisions. Okay, because based on this normal P&L in financial accounting, it's difficult to make decisions in terms of the profitability of each product. Okay, any questions? No? Everyone's good? Okay, so now we have an activity. So I have here Frederick asking to go back one slide. Okay, let me just go back one slide before this activity. The P&L by function. So P&L by function. So we have there the costs categorized according to the business function. So the first item, so number 2, is only manufacturing costs, and then selling costs, it will include personal costs, depreciation, etc., only related with selling costs, and so on and so forth. So we just categorize costs differently and also assemble the P&L in a way that helps managers to make decisions. But at the end of the period, the profit should be the same. It shouldn't change. It's just a way of categorizing costs. Same costs, same revenues, just categorized differently in the P&L. Okay? So now we will have an activity. So I will divide you in breakout rooms in pairs, okay? So we'll try to see how it works. And then there's on Moodle. Let me make it available on Moodle. Let's see if I can make it available. Okay, so if you go on Moodle, you can see there on today's class a mandatory activity, which is in-class problem. So I will divide you in breakout room, in room of pairs, and you both have to work together and answer the questions. It's only 2 questions, so it's 15 minutes. So let me try to create the breakout rooms. Okay, let me see if it works. Okay, so I'm creating the breakout room. So you will be assigned to a room. You will be assigned to a room, and then you will have to work. You have to work. Let me try to figure out. Just give me a second. Okay. You have to work together and submit on Moodle in 15 minutes a PDF file or a Word file. A Word file with the answer to the question. So you can already go to Moodle, and I will now open the questions. So we have there Yannick asking to work with Danielle. Sorry, let me see if I can do that. Where is it Danielle Perino? Danielle Perino. Okay, and okay. Okay, so breakout rooms opening now, and then you have 15 minutes, okay, to submit on Moodle.
Hello. Hello. Okay. Shit. Ja, mein sein Mic geht nicht. No problem.
Hi.
Hi, how you doing?
Doing fine. What about you, bro?
Sorry?
Doing fine. What about you?
Oh yeah, I'm fine too. Thanks. Um, I just had a look on the question and the exercise. Have you already looked at it?
No, I'm seeing it now. Is the in-class problem, right?
Yes.
PDF file maximum one page answering the following questions. Okay, yeah, just read it.
Okay. So I think it's the company's cost analysis. I think it's manufacturing cost because I think in the beginning of the lecture today she said that direct labor is manufacturing cost. That's what I remember.
Okay.
But I'm not 100% sure.
My first guess would be the same.
Okay, perfect. Do you want to write a PDF or shall I write one?
Either way, I don't mind doing it.
Okay. But I also started writing a Word file, so if you want, I can also do it.
Okay, yeah.
But
Can you share your screen then?
yeah, wait. How do I do this? Wait.
Go to our
Okay,
room, yeah, and then you have the option to do it.
wait 1 second. Yeah, maybe you have to do it because it's not working right now for me.
That's okay. You can just keep writing then, and you just tell me then.
Okay, I just said from our point of view, the work here should be classified as manufacturing cost due to the fact that the work is direct labor.
Okay.
I don't know, I think it's enough, huh? Or shall we say why the two other opinions are not correct?
Yeah, probably.
Yeah.
So you were hired to coordinate the transport. So it's clearly gonna be production overhead. So you should be able to classify it as a product cost. Why shouldn't it be a selling expense? The controller says that it should be classified as a selling expense. I think we gotta say why it isn't.
Yeah,
Selling expenses are the costs associated with distributing, marketing, and selling a product or service.
yeah, right. Where did you read it? Or did you just
No,
see it?
I'm reading it on Google.
Ah, nice. Okay.
I'm
So
saying
what should I?
selling costs such as wages, commissions, and out-of-pocket expenses are the costs associated with distributing, marketing, and selling a product or service. So it kind of fits the description on this one as well,
Yes.
because you're only coordinating the transport, and so
Mm-hmm.
it counts as distribution.
Okay.
So it could also be a selling expense apparently. Okay, the CEO says it doesn't matter, so that one has got to be wrong.
Okay. So what should I write for the controller? Just selling. It's not a selling expense because it's what did you? What should I read there? I write there.
That it's not a selling expense. I'm still thinking. We can skip ahead and see number two, but I'm
Okay.
gonna ask one of my friends that's also doing it. In what concerns the reported net income that he is the chief executive officer. So yeah, I think it's not a manufacturing cost.
It's
Yeah,
not manufacturing cost.
I think it's a selling expense. I
Really?
mean, at least for the accounting Google definitions that you find for each of them, manufacturing costs refer to the costs incurred by a business from manufacturing a product or providing a service. It can include a variety of expenses such as labor, raw materials, consumable manufacturing supplies, and general overhead.
I mean, here it's labor, right?
I don't know if it counts as labor or distribution because you were hired to coordinate the transportation.
But from the production
The
facility.
product should already be the transport of packed
Ah,
drinks,
right,
so
right, 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 right.
the product is already
Already
finished.
finished. Yes, right. Okay, you're
I think
completely
I
right.
think that's why they include like the packed
Yeah.
drinks already.
Okay.
So
Okay. Perfect. Yeah, that's true.
to the distribution storerooms located in various parts of the country. So the only thing you're doing is distribute.
Yeah.
I don't know because
Those distributions like marketing, so it's not the manufacturing cost.
yeah.
Okay, then maybe do you want to rewrite it?
Yeah, I don't mind.
Production.
Yeah, I can share my screen. Can you send me? You can copy paste what you already wrote and copy it on the chat.
I mean, it's wrong because I just said that it's manufacturing cost.
Yeah, but we can just change that to selling expense. At least that's what I think so, but she didn't answer me yet.
Yeah, I think it's true. Oh shit.
Yeah, she also said it's selling expense.
Okay, perfect.
So I'm gonna open up on the words.
Mhm.
So which point of view is correct and why? I'm gonna say that the point of view of the controller is correct.
Mhm. Because it's already a finished product. And that's why it's on the manufacturing cost, right?
Yes. Okay. So I've answered the first one, and now we gotta do the second one.
Mm-hmm.
in what concerns the reported net income for the year. Acho que sim, no? I think so. I think it's in. Doesn't matter for the net income, does it?
I don't know, to be honest.
I think both manufacturing costs and selling expenses are both deductible on the net income in the same way.
Mm-hmm.
But I can check. Yeah, it's different. You always take costs of goods sold, which is
Mm-hmm.
basically manufacturing costs,
Yeah.
and then you also take selling and general expenses after to arrive to the total operating income,
Okay.
which then you do the expenses, the tax, and then you get net income. So
So it doesn't matter.
yeah.
Okay, that's good. Nice. Mm. Okay, we got 2 more minutes.
I don't think we got to do like too much. Like does the answer got to be like 1 page? Because I mean, I didn't write that much to be honest.
Yeah, but I think it's max. I think it's I think our answer short but good. And we have only like 2 minutes left, so
Okay, so
so
I'll share my screen. Wait.
yeah. Because did you see her message? Okay.
I mean, it's a pretty straightforward answer. I don't know what else
No, I
to
think I
put
think I
here.
think I think it's good.
Should we just put like our names first
Yeah,
and
yeah, it's good.
say- I'll rearrange it after.
Mm-hmm.
What's your number?
450
454.
and Tim Tim
Tim.
Luetge
Sorry, can you do it again?
L
E.
no L
L.
U E
U. E.
no I like
E. Okay.
yeah TGE.
T. G. E. Like
Yeah,
this.
yeah, yeah. Actually, it's like a U with 2 points, but I think you don't have the letter.
Yeah, I don't have that one.
Yeah, it's a bonus. Okay, perfect.
Okay. I'll send it to you um, via Teams, I guess. So you
Yeah,
can so you can put it after there as well because we're being invited back.
yeah.
I'll just finish doing it and send it for you to on Teams so you can submit it.
Mm-hmm. On Teams or where?
Yeah, on Teams probably. I'll just search you up with your number
Okay, okay,
and
perfect.
send you the file. It's the easiest way, I think.
Okay, perfect. Thanks. Do you think we both have to submit it, or one person is enough?
I'm guessing we better submit both. I don't see why
Okay,
not.
okay.
Okay, I'm gonna go back now.
Okay, perfekt. Digga, ich hoffe, die ist jetzt hoch, Alter.
Okay, so everyone's back here.
Can we, sorry, Professor, can you still submit? I was in the process of submitting. Or
Yes, finish quickly the submission on Moodle, okay? So everyone finish the submission. In the meantime, while you're submitting, I will continue with the class, all right? So we have now finished the first topic. So we were talking about topic 1, okay, Introduction to Management Accounting, and these different cost concepts. I will now move on to information for decision making. So here we'll be having these different topics. So we are now focusing on information for decision making. Okay, so we will try to work out information that we have in organizations in order to help to develop information to help managers to make good decisions. What kind of decisions? What kind of information? What we will be talking about? So cost, volume, profit analysis. So we want to analyze the profitability in terms of cost and volume of the organization. We want to measure relevant costs and revenues for decision making. We want to do special pricing decisions. Should we make a promotion? Should we, we have this special client. How should we price the product for this client? In terms of outsourcing, should we make in-house? Should we outsource the services or the products that we provide? In terms of discontinuation, in terms of product mix, etc. Okay, so this is what we want to be talking here on topic 2. So I see that few questions here. Okay. Only one person needs to submit the work. Okay, you don't need to submit twice. Okay, so you did the work in pairs, but only one of you needs to submit on Moodle. Okay. Is it okay? Yeah, everyone's good. So if everyone's good.
Sorry, but we did actually submit it twice. But
I'm trying to submit right now as well.
Okay, if you submitted twice, okay, you already did. If you're trying to submit, it's just uploading the file on Moodle. It is very quick while you do that. So I will just continue talking because I'm just introducing the topic. So it's nothing super important now. I will just continue while you do that in the short time. So as of now, we will be talking about cost, volume, profit analysis. Okay, and you can read more about this on the book chapter 3. Okay. So the objectives of cost, volume, profit analysis is to determine the break-even point and also explain what it means, the break-even point, what is this concept about, is to determine the margin of safety and also be able to explain what the margin of safety is to have not only do this for a single product, but also when we have multiple products, which is the case of most organizations, and also to understand the assumptions of this type of analysis. Okay, so this type of analysis is very useful for organizations to understand in terms of profitability, in terms of volume, in terms of pricing, how they should go forward. But it has important assumptions. So we will be understanding these assumptions because this is really important for the future. Okay, when you do this in organizations. So now we are going to classify costs in terms of how they behave in relation to output. Okay, so for this topic, we want to understand how costs are classified in their relation to output. So are these costs fixed or variable? Okay, so this is what we're trying to do here. So how do we understand, how do we identify? So we just answer the question, how do costs behave when the level of activity changes? So if we produce more, if we sell more units, So in terms of volume, level of activity, volume, if we have more units, will the cost change or not? So if the cost changes, it means that it's variable. If the cost does not change, it means that it's fixed. So fixed costs, they remain unchanged in total as the level of activity varies. So as an activity increases, the total fixed costs, they do not change, they remain the same. But unit fixed costs, they decline. So we will see this graphically in a bit, which helps to understand. So examples of fixed costs, we have the straight line depreciation, we have insurance, property taxes, the rent, supervisory salaries, administrative salaries, advertising when this is fixed. When we look at variable costs, these are costs that change in total in a direct proportion to a change in activity. So if we produce more, we will also have a higher cost in proportion to the volume, to the increased volume. What happens when we look at the unit variable cost is that it remains the same. Examples of variable cost is, for instance, direct materials. If we produce more chairs or more tables, we will use more wood, okay? Because each unit requires a certain amount of wood, and if we produce more units, we will have a proportional increase in the material of wood that we use there. So examples, direct materials, direct labor, electricity, commissions, shipping costs, etc. So variable costs, they are activity-based. So depending on the level of activity, they change. Examples of activity-based costs we have there. So for instance, labor hours, machine hours, units produced, units sold, miles driven by the sales personnel, number of beds occupied in a hospital. So these are some examples of activity-based costs. Now notice that we have there a little star in fixed costs, because fixed costs, they are fixed for what we call the relevant range. So fixed costs are only fixed in the short term, because in the long term, everything is variable. So for an example of a fixed cost is the rent of the factory. So we have this rent independently or on the number of units that we produce, we will pay the same rent. So it's a fixed cost. But let's imagine that in the long range, when we have a long time period, let's imagine that the demand of our products increase so much that we need to double the factory space. So we increase the rent. Or let's imagine everyone is now working from home. We don't need to rent the offices because everyone is home working. So this becomes a variable cost. We decrease the cost with the office rents, for instance. Okay, so in the long range, everything is variable. Costs are only fixed in the short period. Okay. Any questions so far? No? Okay. So to visualize, when we look at variable costs, these costs, they increase as we increase the activity level. These costs increased. Let me just see if I can. No, I cannot try to see to show you with the mouse here. So, but as you see, we see as we increase the activity level, the fixed costs, they increase, and they increase in a proportional level to the level of activity. Okay, so it's always the same slope when we look at the variable costs in total. But when we look at the variable costs per unit, as we increase the activity level, per unit is always the same. So per unit, the fixed cost is fixed, okay? And when we look at the fixed costs in total, they remain unchanged, they remain fixed, they do not change. So if we produce more units, we in total have the same fixed costs. But when we look at the fixed costs per unit, this actually decreases. As we produce more units, the cost of each unit will decrease. Okay, questions? No? So we have fixed costs and we have variable costs. And obviously, often things are not that black and white as we talked about last week. So we have here what we call the step fixed and the semi-variable costs. So step fixed costs is those costs that remain fixed over a range of activity. Okay, let's for instance look at machines. So we have these machines, and with these machines we can produce a certain amount of product. But if we want to change the level, so after a certain level of activity, what needs to happen is we have to buy a new machine. And for that machine, we will again produce, another range, another amount of product. So these are step fixed costs. Can be, for instance, the depreciation of the machine, can be, for instance, in terms of labor. So a certain employee can do so much in terms of activity. And then when we hire a new employee, it will again jump in terms of capacity of the organization. So this is step fixed costs. Another type of cost is the semi-variable costs. This has both a fixed and a variable components. The typical example is the telephone charges. So we pay a fixed fee to the company. Okay, so it's when you look at the graph there, when you look at the graph on this side, more or less, see, even if the level of activity is zero, you pay a fixed fee. And then depending on the level of activity, you will have a variable cost. So there's a component of fixed cost. So independent of the level of activity, you pay that fixed cost. And then as you increase the level of activity, you will have a variable cost adding to the fixed cost. So it is a semi-variable cost. Okay, questions? No? Okay, so I have a quiz here, so I will open a pool. What I wanted to do is to put the boxes that we have at the bottom within the boxes that we have empty. So I will launch the pool. I will launch the pool and I will ask you to answer. So box A, which says that the cost increases as the volume goes up. There's a positive association. So this should be going to box 1, to box 2, to box 3, or to box 4. Then we have box B, which says that cost decreases as the volume goes up. So there's a negative association. Box C, box C says that it remains the same. Okay, so let's vote. We only have 53% of people who already answered. So let's try to vote quickly in the next few seconds. So we just need to put the boxes A, B, and C in the squares that we have 1, 2, 3, and 4. Okay, everyone, I will close the poll quickly. Let's finish your votes. Okay, so let me share the results. So you have here, most of people said that box A, cost increases as the volume goes up, should go to box 1. So that is when costs increases as the volume goes up, there's a positive association. And you're saying that, that is when variable costs in total. So as the volume goes up, these costs increase. Yeah, that is correct. Then on box B, which says that cost decreases as the volume goes up, or where there's a negative association, most of you said it should go to box 4, which is fixed costs per unit. And that is also correct. Very good. And finally, box C, most of you answered the last one, boxes 2 and 3, and that also is correct. Very good. Wonderful. So, moving on, cost volume profit analysis. We also talk about it as CVP analysis. Okay, so it helps managers to understand the relationship between cost, volume, and profit. That's why the name cost, volume, profit analysis. So it focuses on how profits are affected by the selling prices, by the sales volume, the unit variable costs, the total fixed costs, and the mix of products sold. So this is obviously very important for organizations because they want to, for instance, understand how the profit will change if they change the price, if there is an increase or decrease in volume, if they change the unit variable costs, or if they change total fixed costs, or if they change the mix of products. So if we sell more of product A, how will that change the profitability of the organization? So this is really important for organizations to have a very quickly understand the impact on profit of these variables. So as you remember, profit is the difference between revenues and costs, and we have both variable and fixed costs. So we can arrange the formula and see that the profit is equal to the selling price per unit minus the quantity sold, times the quantity sold, minus the variable costs per unit times the quantity sold, minus the fixed costs. So what kind of questions do we answer with this type of analysis? So for instance, what products and services do we offer? What pricing policies should the company follow? What would be the effect on profit if you reduce the selling price and sell more units? Or how many units we should sell in order to break even? Or what sales volume is required to meet additional fixed charges arising from an advertising campaign, for instance? So these are some questions that managers have on the day-to-day when they need to make decisions. They need to have information in order to answer these questions. And this type of analysis, the CVP analysis, helps managers answering these questions. So let's look here at these graphs. So here we have what we call a curvilinear CVP relationship. So the red curve there between point A and point D is the total cost line. And then we have in blue the total revenues. So on the X, we have the units of production and sales, and in the vertical line, in Y, we have the costs and revenues. So we see when the company is producing, it has a small level of activity, so it's producing and selling very few units. What we see is a very steep costs. So each extra unit will cost a lot. It's very expensive to produce. So looking between points A and B, it's a very steep curve. So it's very expensive to produce one more unit because we are producing each unit individually. We have a lot of costs, and we need to incur in these huge costs in order to produce one more unit. So this is when we see, startup companies when they're starting, they have to produce one more unit, so they have to, purchase all the machines. They have to have all these employees in order to start developing. So there's a very steep curve between points A and B. But then, when they start producing more units, they become starting to have economies of scale. So they become efficient in what they're doing. So they already know how to produce. Everything is arranged. It becomes efficient. So we have between points B and C a lower slope because they already know how to do things. So the level of cost of each extra unit is not that much. So this is normally what we see the company should be in this area. So in terms of level of activity, they should be operating between points B and C when we look at costs. And then after that level of activity in point C, we see again a very steep curve between point C and D, which is when the companies start going above the capacity. So when they start producing too much, what happens is that, the employees will be very tired, will be doing extra hours. So when do the extra hours, we have to pay extra to these employees, very expensive. Or we start operating the machines more without the proper maintenance breaks. And then the machines break down, and then we have huge costs in repairing the machines. So when we go above this point C, each extra unit, again, costs a lot of money to the organization because it's above the capacity. So this is when we look at the curve of costs. And then when we look at revenues, normally revenues, they increase. And they keep increasing. But there's a point at which if you want to sell more, what we have to do is to decrease prices. So we see that between point 0 and point E, we increase as we sell more quantities. We keep our revenues increasing. But then after a certain point, if we want to sell more, as we have to decrease prices, we actually start seeing the revenues decreasing. Okay? So this is what we see in curvilinear relationships, and this is what normally happens. Now, for us, in order to try understanding this, because it is a basic course to try to understand the CVP relationships, we will be looking at linear CVP relationships, okay? And this means that we will only look at the relevant range. So when we are focusing only on the relevant range, in the short term, okay, when the fixed costs are fixed and the variable costs are variable, because you remember when we look at what I mentioned before, the fixed costs are only fixed in the short term. In the long range, the long term, everything is variable. Okay, so we will have these, as we saw in the previous slide, this curvilinear relationship. But if you look, when we in the short term, we can make these assumptions and assume a linear CVP relationship. So what we have in this linear relationship? So we will have constant variable costs and selling price. So this is an assumption. There's only one break-even point. Okay, if you see before, there's 2 points in which the red and blue line, they cross each other. So there's 2 break-even points there when we have a curvilinear relationship. But when we have a linear relationship, there's only 1 point in which the revenues cross the total costs. Okay, that is the break-even point. And so we are also assuming that the diagram that we see here is an accurate representation of the costs, because this only happens in the relevant range. So we see there the fixed costs in pink, like the straight line, the horizontal straight line. We have in blue the total revenues, and we have in yellow the total cost, which will be the sum of the fixed costs and the variable costs. Okay. Now here is extra detail of this break-even point graph. So we see that.
Can I just ask one question regarding the slide before?
Back.
how do you actually define the relevant range? Does it has to do with the economist's total cost that we showed, like the curve, the curve of the line?
So normally the relevant range is in the short run. So the assumption is that the relevant range is that the fixed costs, they are fixed. So let's, for instance, consider a factory. So we have this company with a factory and offices. And what are the fixed costs that they have? They have fixed costs with employees. They have fixed costs with the rent, with the depreciation of the machines. So these are the fixed costs. So from today to tomorrow, these costs will be fixed, right? But when we look in 1 year period, well, in 1 year, the company can stop the contract, the renting contract, right? So they have the renting contract with the owner of the factory. So they can say the owner of the factory, normally these contracts, they have a fixed period and you have to give notice to end the contract of a few months. So you can end the contract. You can also end the contract with employees. Or when we look at if you want to increase capacity, how long it takes to hire new employees. It normally takes a couple months if you want to hire specialized employees. So normally we look at the relevant range of about a year, okay? So this is what a normal assumption. So in 1 year, there won't be a huge difference in terms of variable costs, in terms of selling price, and in terms of fixed cost. These should remain more or less constant in the period of 1 year. But then beyond 1 year, things might change. Okay, so normally we consider as 1 year the relevant range. But it can be different for different industries. Okay, so in some industries, we can see the costs that they change very quickly. So, and then there is a huge volatility in the market. The market is very liquid. So there the relevant range might be shorter.
Okay,
Does it
thank
answer
you.
the question? Yeah.
Yes, thank you.
So we have another question here. What is the economist's total cost? So this economist's total cost that we have there is actually kind of bringing back the idea that we had before in terms of the curvilinear relationship, okay? The ones that we have here in the red line is just to make the bridge between what we had in the previous slide and what we have here in this slide. Okay, so the accountant's total cost, it is assuming that these costs are fixed. For instance, when we look at the yellow line, accountant's total cost, it's straight, it's a straight line. And that compares with the economist's total cost, which assumes these economies of scale and that after a certain point, we need to incur in extra costs. So that goes, that is what happens outside of the relevant range. In order for us to assume a linear CVP relationship, we are assuming, these are fixed. We have constant variable costs. We have constant selling prices, and we also have fixed costs. Okay, so these are the assumptions, and this is just to make the bridge with what we had in the previous slide. Okay, any more questions? Anyone? No? Good. So here is another graph of the break-even point. So you see there we have the sales revenues, which is steeper, and we have the total costs. Okay, and when they cross each other, we have the break-even point, and we see that the break-even point, above the break-even point, we have profit, the green area. So when sales revenues are higher than cost, we have profit. And when costs are higher than revenues, we are at a loss. So we can calculate the break-even point either in terms of units, so how many units we need to sell in order to break even, and we can calculate the break-even in terms of monetary value. How many euros I need to sell in order to have a profit equal to 0. So break-even is when we have profit equal to 0, is when the sales revenues and total costs, they cross, means that revenue is equal to costs and therefore profit is equal to 0. I will leave these here. These are from the book. I will leave these on the slides, and I want you to later, when you look at the slides, to review and try to understand. It's basically the same graph. It just shows it focusing more in the blue one, between the fixed costs and the variable costs, for you to understand better the relationship. So I just want you to later look at both of these graphs to try to understand graphically the relationship between fixed costs, variable costs, revenues, and profit. Okay. Now, when we look at the P&L by function, so we have talked about P&L by function earlier today, and now we can also assemble the P&L by function with the contribution margin format. Is when companies, they want to understand not only the costs in terms of function, but also they want to understand what they can change in the short term. So they do the P&L by function with the contribution margin format. So if you look at the items that we have there, we start again with sales revenues as always. Then we deduct the variable costs. And we deduct both manufacturing and the non-manufacturing variable costs, meaning administrative variable costs, selling variable costs, etc. The difference between sales revenues and variable costs is the contribution margin. Okay, and there we have here in orange several ways to calculate the contribution margin. So we can calculate the contribution margin as sales revenues minus variable costs. In total, we can calculate per unit, and we can also calculate the contribution margin as a percentage of sales revenues. And this is very important when managers want to make decisions in the short term. For instance, nowadays, when we had this pandemic and companies had to close down the stores, so managers had to make decisions very quickly for looking only at the short term. And in the short term, what they can manage is the variable costs, because the fixed costs in the short term, they are fixed. There's no way around that. So in order for managers to make decisions in what they should do now in this period of lockdown, they could calculate the contribution margin. For instance, if you look at restaurants, when you look at restaurants, they have to think about, are we going to remain open or not? Are we going to sell, takeaway, to make deliveries? Which products are we going to sell? So to make these kind of decisions, the best way is to look at what is the contribution margin. If we make full meals, if you only sell pastries, if we make deliveries, so to look at the contribution margin of each product in order to understand if it makes sense or not. Because what happens very often in companies is that overall, they are profitable, but then they have this set of products that are very, very profitable. They have a very large margin, but they also have those other products with very low margin, or even in which they are at a loss. But these are needed in order for the company to satisfy all clients and therefore have a wider range of clientele. So when they have to look at the short term and make decisions in the short term, they can do this analysis and look at the contribution margin in order to make decisions on which products to sell under special circumstances as we are living at the moment. Okay? Any questions? No? Okay, so contribution margin. So when we talk about contribution margin, it's contribution to what? So we know that it is equal to sales revenues minus variable costs. So it's the contribution is to first to cover the fixed costs. Okay, so contribution to cover the fixed costs, and then after covering the fixed costs, any residual amount that we have from the contribution margin, it actually contributes to profit. Okay, so is what the company will be having left over, so sales revenues minus variable costs. So the contribution margin is what the company has left over to pay fixed costs, and any remaining amount is profit. If you look at the P&L, it's very obvious. So we have the contribution margin there. So what does it cover? It covers fixed costs first. It covers fixed costs, and if there's anything remaining, it will cover. It will be the profit. So an important concept in terms of contribution margin is the contribution margin ratio. So the contribution margin ratio shows how the contribution margin will be affected by a change in the total sales. So we can calculate the change in the contribution margin to be equal to the contribution margin ratio times the change in sales. So let's look at this example. If we have a contribution margin ratio of 40%, it means that for each increase in sales, the contribution margin will increase by 40 cents. So each euro, €1 that we increase in sales, means that contribution margin increases by 40 cents. Because fixed costs are fixed, that means that the profit will increase by 40 cents. So if you think about it, this is a very powerful tool for organizations when they know the contribution margin ratio to very quickly see the impact on profit. Okay, so they can calculate the impact on profit on how much, if there's an increase in sales, how much that will impact on profit. And they can do this very quickly with the contribution margin ratio. Now, we can derive the formula for the break-even point when we take this cost volume profit analysis. So when we look at the equation, we know how to calculate profit, the sales revenues minus variable costs minus fixed costs, and we can arrange the formula to derive the break-even point formula. We know that at the break-even, the profit is equal to 0. Is that level of sales which we can measure either in units or in monetary values, in euros, for instance, in which the sales revenues is equal to the total costs. So there is no profit and there's no loss. Profit is equal to 0. So we can derive, and we have here the formula. So we make the profit equal to 0, and we work around the formula. And these formulas are important. Okay, so just make sure that you remember these formulas. So we can, to calculate the break-even point in units, it's equal to the fixed costs divided by the contribution margin per unit. So make sure that you take note of the formulas. And when we want to calculate the break-even point in euros, in monetary value, is equal to the fixed costs divided by the contribution margin ratio. Or, if we know the break-even point in units, we just multiply break-even point in units times the selling price per unit. Okay, everyone took note of the formulas? Yep. Because now we have a quiz. So I will launch another pool. So if we have the sales unit selling price of 15 euros and a variable unit cost of 5 euros and total fixed cost of 5,000, how much is the break-even point in quantity? So break-even point in quantity. Okay, a few more seconds for you to answer. Okay, I will finish now. Make sure you voted there. So 500 units.
Sorry, Professor, I was just trying to answer when you closed. But yeah, I will also put 500
Okay, so you
units.
have to be very quick, okay? You
Yeah,
have
me
to
as
be
well.
very quick.
Yeah, sorry, because I didn't have my calculator with me, so I had to go into
Okay,
Submit.
make sure you get your calculator there, okay?
Yeah, now I have it.
Okay, so what is the correct answer? 500 units. So most of you got it right. Very good. So sales, if you have a sales unit price of 15 euros and a variable unit cost of 5 euros, that means we can calculate the contribution margin per unit. Selling price minus variable cost per unit. Contribution margin per unit is equal to 15 minus 5, which is 10. And if we have total fixed cost of 5,000, and we know the form of break-even point in units, which is fixed cost divided by contribution margin per unit, 5,000 divided by 10, we have 500 units. So very good. So when we have taxes, we just use the same formula times 1 minus the tax rate. Okay? We will not be doing much exercises with taxes, but it's just for you to keep note of these. Now, when we have more than one product, and here's when it becomes a little bit more complicated, and this is what really happens in most of the organizations, they sell more than one product or provide more than one service. How to go about it? So fixed costs, normally they are not per product. We have fixed costs in total. So the factory produces a lot of products. So the total fixed costs in the factory and in the whole organization, so also administrative, selling, etc., all fixed costs is for all products. So what do? We calculate the total break-even point, but we have into account the sales mix. Let's imagine we want to calculate break-even point in units. It will be the fixed cost divided by the weighted average contribution margin per unit. What is this weighted average contribution margin per unit? We will see what is the sales mix that we have in terms of products. For instance, in this example, we have product X and product Y. We have the unit contribution of each product in euros, so the contribution margin per unit of each one. And we have the actual sales mix in quantities. So if the company sells in total 100 units, we know that 25 units are for product X and 75 units is of product Y. We calculate the weighted average contribution margin, so just multiply 25% times 12 plus 75% times 8. So we have the weighted average contribution margin, and then we apply the same formula of the break-even. So this will be the break-even point the global break-even point in units. Then if we want to know the break-even, how many units we need to sell of each product, we take these 20,000 units and multiply how much will be of product X, 20,000 times 25%, and of product Y, 20,000 units times 75%. Okay? So there's two steps. We have the two products. We calculate the sales mix of each product. We calculate the weighted average contribution margin for all products. Then we calculate the break-even point, the global break-even point, okay? And then we have the extra step of, after having the whole break-even point, to see how much we should sell of each product, okay? So this is we have to have this extra step. Now, this is the way we do it for units, but it's the same way if you want to do in euros, okay? So, but we have to be consistent. If you want to calculate the break-even point in euros, when we do the actual sales mix, it will not be the sales mix when we calculate in quantities. It will be the sales mix in terms of sales revenues. Okay, that it needs to be consistent. Another way would be to calculate in units if you want to know the break-even point in euros, to see how much is the break-even point in units, and then just multiply by the selling price. Okay, any questions? No? Okay, so I leave here on the slides a few more formulas. It's always starting from the formula of profit. Profit equal to sales revenues minus variable costs minus fixed costs. Just working around these formulas, depending on what we will work out, depending on the information that we have available, we can keep these here. Any questions? No? So we have now a target profit, and we will just finish this target profit before we go for break. Okay. So target profit analysis. Let me see. I have here Rodrigo to go back one slide. I can go back one slide. Yes. So this is this the slide of formulas? Any specific questions? No, thank you. Okay. So target profit. This is part of the CVP analysis. So let's imagine we have the CEO of the company wants to have a profit of 1 million euros. So if you want to have a profit of 1 million euros, how much units we need to sell? So this is the question. Okay, and in order to answer the question, we use this CVP analysis and we work around the formula. So if you want to have profit equal to 1 million, how many units we need to sell? We just work out the formula and get there. For instance, if the quantities, we want to know the quantities, we work out the formula in order to have the quantities. So that would be the first orange box that we have there, in which we have the target profit is equal to the fixed cost plus the target profit divided by the contribution margin per unit. Let's imagine that the CEO wants to know how much should be the sales level in euros in order to have a profit of 1 million euros. We do the same formula, but instead of dividing by the contribution margin per unit, we divide by the contribution margin ratio. If you realize this is pretty much the same as the break-even point formula, the difference is that we add at the top, together with the fixed cost, we add the target profit. And this will give us the units or level of sales that we want to have. So now we will do this example. So this example, we have here the fixed costs per year, 60,000 euros. We have a unit selling price of 20 euros. We have unit variable cost of 10 euros. And the relevant range is between 4,000 and 12,000 units. The first question is how many units have to be sold in order to obtain a 30,000 euros of profit. So make sure you make print screen of this example, and I will try to use the whiteboard and see if it works better today. I have to bear with me because this is all new. Okay, so if you want to know the target profit, and we knew that we have fixed cost of 60,000 and selling price per unit of 20 and variable cost per unit of 10, then the first question, we know that the formula in units, because we want to know in units, we know that it is fixed costs plus the target profit divided by the contribution margin per unit. So we can calculate this. We have all the information. So we can say that the units that we need to sell will be equal to the 60,000, that is the fixed costs. We want to have a target profit of 30,000 euros, and we will divide by the contribution margin per unit. So that is the selling price per unit minus the variable cost per unit. And that gives us 9,000 units. This is how much we need to sell in order to break even. The second question, let me show you the second question. Let me try to share the second question. It just takes a little bit time of commuting between one and the other slide. So the second question is to know the additional sales volume to meet 8,000 euros of additional fixed advertising costs. Okay, I already saved there the second and third question. So we want to know how much extra sales volume, so how many units extra we need to sell in order to cover advertising cost of 8,000 euros. So the marketing guys, they had this idea of making this advertising campaign which costs 8,000 euros. So we want now to know how many extra units we have to sell just to break even, just to pay off this extra marketing cost. Okay, so that is the second question we will answer. And then also keep there the third question, which is the selling price that we will need to charge in order to have a profit of 30,000 euros with the sales value of 8,000 units. Okay, so now let's go back to the whiteboard. So question number 2, we want to know how many units we need to have to cover the extra costs. So we have an extra cost of 8,000 euros, and we can just calculate in order to know the units. There's several ways to go about it. So I will now write down one way, which would be to divide the extra cost divided by the contribution margin per unit. This would be 8,000 euros divided by 20 minus 10, which would have 800 units. Another way to go about it, would be to do the same as we had before, but with this extra cost included. So we would make the 60,000 fixed costs that we had, plus the extra 8,000 of this advertising campaign divided by the 20 minus 10. This would give us 6,800 units. So what we would now need to do would be to make the difference. So between what we had, between the break-even, which doesn't include this 8,000, that would be 6,000 when we do the difference, 6,800, minus the original without the extra cost of 8,000, which would be 6,000, and this would give us a difference of 800 units. Okay, so these are two options to go about this question, and you can choose the one that you prefer. Okay. Any questions? No? So let's just now go to question 3. And in question 3, they are asking us the selling price when we want to have a profit. So we want to know the selling price. with a profit of 30,000 and a volume of 8,000 units. So we know the formula. The formula is the profit equal to selling price times the quantity minus variable cost times the quantity minus fixed costs. So here we have incognita, and the incognita is the selling price. So if you just work out the formula, we get that the selling price, so I will let you work out the formula later. If you just work out the formula with the information that we have available, so we actually know the profit we want to have is 30,000. We know the selling price is 20. We want to know the quantity. This is variable costs. So we know the variable costs are 10. We want to know the quantity, and we know the fixed costs are 60,000. So from there we can calculate. We don't know the selling price. That is what we want to know. So selling price. We do know the quantity, which is 8,000. Yeah. So we can get the selling price if you just work out the formula. The selling price equal to 21.25 euros. So we know the profit. They tell us a profit of 30,000 euros. They tell us that that profit is for a level of activity of 8,000 units. So if we do that, we know the fixed cost is 60,000. We know the variable costs. We just want to know the selling price. So we have one incognita only, which is the selling price. Okay? Very good. So any questions? No? So we will have the break now. We will return in half an hour. Okay, so when it is 37 past 2, we will be back. Okay, so enjoy your lunch, and I will see you in a little bit.
Thank you.
Thanks.